Hi, this is Fred Sroka, and I'm here with Serbi Bordia. Serbi, thanks so much for joining us.
Thanks, Fred.
And hopefully we can learn a little bit about the state of international tax from
Right.
you. So you joined our adjunct faculty recently, didn't you?
Yes, I did. It's been 3 months now, and I've been enjoying this.
Wonderful. Tell me, when you walked into the classroom, you're clearly an expert in international tax. Does it change the way that you approach the material?
I keep on telling my students that, I am learning more when I'm teaching because there are so many intricacies in the law, and when you're answering those intricacies, it makes you more and dig deeper, and that really changes perspective.
It does, and it's part of why I love this job. Teaching just really gives me that joy of discovery pretty much
Exactly.
every day.
That's true.
Well, it's great to have you on the faculty, but you're also a director in the International Tax Group
That's
with
right.
PricewaterhouseCoopers, right? Wonderful. What I'd love to do would just be get some general thoughts from you on, first of all, what's happened from a U.S. tax perspective for multinationals, because we just had an election and things like that, they might start changing.
Right.
And then a sense of what else is happening around the world. Would
Right.
you mind sharing your thoughts on those?
Absolutely.
Great. Let's start with, we had an election on November 8th and things look a little different.
It does, and I think now we are, in fact, most of us are anticipating the reforms to come. There are two main proposals which are out there. One is Donald Trump proposal, and the other is House Republican blueprint proposal. Donald Trump proposal essentially has 15% tax rate on the C corporation. Pass through may elect for 15% tax. But I don't know how that things are going to work out. If they are making a huge dividend to the corporations, there might be some heavier tax implication over there. And I think one of the key thing is that the proposal essentially eliminate most of the expenses except for R&D credit. So that's one of the big thing in Trump proposal. We might anticipate one-time 10% deemed repatriation on offshore earnings and profits. So as you may know, there is 2.3 million and maybe 2.3 trillion dollars sitting offshore, and that 10% leeway on the tax rate may bring much of the earnings and profits back to the United States.
So
those are the big
basically,
thing.
we might want to wait to bring any money home because it might be cheaper to bring it home in the future.
That's probably the way it looks like right now, yes.
Got it.
Yes.
So from an American perspective, sit tight, probably defer recognition of income or repatriation would be a good summary of
I would say,
international.
I think it's just my personal observation, waiting for 3 to 4 months probably will make sense because we will know what exactly we are getting from the tax reform perspective. So Blueprint has essentially proposed for 20% tax rate for the corporations, 25% tax rate for the partnership. They have also proposed for 100% expensing for equipment and any real property, but not land. There is going to be if the blueprint is enacted, then there is likelihood that we are in the territorial system. So essentially, no foreign source income is going to be taxed in the United States. So that's the biggest thing in the blueprint. And there is going to be a mandatory deemed repatriation, which is quite different with what Trump has proposed.
Got it. So we really don't know, but we're not expecting tax rates to go up under either plan. We're expecting them to go down.
That's right. Yeah.
Sit tight, hope for the best, and who knows?
Exactly.
Wonderful. Well, if that's the guidance from a U.S. perspective, other nations certainly aren't doing that. There's an awful lot of activity. Could you give us a sense of what other countries are doing at the moment?
Exactly. Yeah. So I think OECD BAPS, which I'm assuming everybody is familiar with that. So OECD BAPS guidelines came out back in 2015, and much of them, they are very much finalized for all the 15 action items. What we have seen so far, so UK and Australia has enacted quite a few from the OECD BAPS guideline. There is a DPT rule which is already out from the UK, DPT rules which is already out from the BAPS guidelines. Then Australian MAL rule which is also coming out from the BAPS guidelines, but they have their own changes to manifest into their unilateral law. And those are harsh, those are tough, and they are really complicated. So if you have any UK sales going on, if you have UK commissioner, or even if you have Australian LRD arrangement, I would say, like, look into your structure, make sure that you don't have any deemed PE or national PE or any royalty withholding taxes from UK perspective in your structure, which may come in audit or anything. So EU ATAD, which is European Anti-Tax Avoidance Directive, essentially is expected to come no later than January 1st, 2019. And what it does is essentially it basically brings them unilateral law changes to curb or to curtail some of the areas which we are going to talk about briefly. The areas which are addressed in the ATAD were interest limitation, which is quite similar to the earnings stripping rules in the United States. I mean, only I'm just giving you an analogy. The rules are going to be different, but it's just like to curtail the interest expense. Hybrid mismatches. So if there are any mismatch with respect to entity classification, with respect to financial instrument classification, then there are rules like how those mismatches result into double deduction or no inclusion and deduction scenario. If one of those things happen in that structure, then the countries have to enact a law to tax that income, which results into double deduction or no inclusion and deduction. There is going to be CFC rules, exit taxation, how you're going to tax the IP. So that's one of the things which we are going to watch out for. And then the other one is general anti-abuse rule. Like if there are going to be any income which are not going to be taxed in any recipient country, then how the countries are going to bring the changes in the payer country perspective so that income gets taxed either in the payer country or in some other country. And then there is going to be a switchover clause. So these are the basic 6 areas where we would see the EU is going to bring the changes by 2019, January 1st, 2019. So lots of activities, as you said, lots of activities to anticipate.
Right. And would it be fair to say that the majority of those changes are designed to either undo the fancy tax planning that advisors have been doing internationally for a lot of years, and secondarily to try to get more money out of U.S. multinationals like Apple?
I think I will say the second one, but I think this is my understanding. No law has identified that the tax planning was bad or was illegal. It is like always permissible from the U.S. tax perspective. Yes, now we have seen there is a heightened scrutiny from the substance standpoint. So if entity is earning, any entity, let's say IP owner in Bermuda is earning residual profits and doesn't have the substance, then yes, that's going to be scrutinized by the other local jurisdictions or local countries where there are sales activities. So the whole idea is like, hey, if UK and Australia or France, they are the revenue market and you are generating the revenue from those markets, but those revenues are just getting at like 5% or 5% of like net profit, or you're just paying the 5% of the net profit taxes in those jurisdictions. Rest is going tax-free. So this has really broadened the scope of the local tax authorities to audit, scrutinize, and will have amplified consequences.
Right, and we're seeing it on 3 fronts, right? Because the substance, you can't simply form a corporation and say that will save me money. But also PE, especially with all this e-commerce, countries are lowering the threshold to when you have a taxable presence.
Right.
And isn't transfer pricing the one that really is dramatically changing under these BAPS
I
rules?
think all those 3 things which you have touched is like very critical, and the countries are making the changes to the unilateral law, like in their own tax legislative changes. They are essentially keen to ratify the treaty so that the permanent establishment has like much more broader scope of giving the treaty benefits. Narrower scope and providing the treaty benefits. And then the transfer pricing, that's the biggest thing, because how the companies were compensated, associated enterprises were compensated earlier before BAPS, it's going to be totally different post-BAPS. it's all goes back to DEMPI function, which is like, hey, what substance do you have? Where are your development activities happening? Where are your maintenance activities happening? Where are your production activities happening? Where are your extraction activities happening? So it's essentially like, looking into like all those functions and evaluating whether the profits are attributed based upon function, risk, people, and assets.
Got it. Thank you, Surabhi. So if I had to guess at a general thread for our expectations of U.S. tax, it's maybe lower. Internationally, definitely higher.
Yeah, oh yeah, it is actually, and we will every month there's some new changes. And this is the era, this is the period we are living where like you have to be aware of all those changes which may impact the companies from the ETR perspective, from the FIN 48 perspective, and from the cash tax perspective.
So another area of change, Surabhi, is in government's sharing of information. Could you give us some sense of what's happening with governments? They used to kind of fight with one another a lot, but it seems like increasingly they're realizing they can play the game better by working together.
And I think that's right. Fred, I think like the country-by-country reporting essentially address that issue. Many countries have already had this unilateral changes in their legislation where the companies are required to file the country-by-country reporting or local reporting depending upon where the parent corporation is resident of. Similarly, like I think the U.S. has also came up with the rules on the country-by-country reporting. And what country-by-country reporting does is essentially shares the information by one government with another government with respect to revenue, with respect to the sales by each jurisdiction, with respect to employees' function, tax rate. And it gives them like more transparent view of the entity operations and also entities' tax consequences.
And so if I remember from my time as a small child, I could try to tell mom one story and dad maybe a slightly different version of the same story.
That.
It gets harder and harder, doesn't
there
it?
is going to be a consensual arrangement there now.
Wonderful, thank you. Surabhi, another area that we see a lot of activity has to do with state aid, where countries are trying to subsidize or encourage companies. Could you give us a sense of what's going on in that area?
So I think like giving a little bit more background, like where the state aid is coming from. So European law essentially prohibits market distortion. And if there is a market distortion by way of providing state aid, which is on the selective basis by EU member state, then there is possibility that may be prone to the state aid. So that's the broader overview of the state aid. What is selective? So I think the key criteria for state aid, as I mentioned, is like whether the practice is selective, and in order for any authority to depict whether the measure is selective or not, there are three criteria. The first is like understanding the legal framework where any company is operating. The second thing is like whether any incentive provided to any particular company derogates or provides or distorts the competition or that framework which like all the broader companies are dealing in. And the third is whether the derogation or distortion can be explained in a general scheme of the framework. I mean, if it's not explained, if it cannot be explained in the general scheme of framework, then there is a possibility that there is a distortion. And if there is a distortion, then there might be a possibility of the state aid.
So state aid sounds like an odd concept, but basically if my client thinks that they're simply negotiating a good tax rate with a country, it could be instead that the deal's going to get called off because the EU is going to say, no, that's actually a subsidy coming from government?
That's right, and I think that's what we have seen, like in some of the cases, like the Apple case, right? The Apple case ruling that came decision, not the ruling. Sorry, the decision came out, and where Apple was essentially like asked to pay the retroactive taxes, like from the date Apple seek the ruling. And that essentially amounted in 14.3 billion of taxes, and that's huge. And it's not only Apple. It's going to be McDonald's. It is going to be Starbucks. It's going to be Google. So there are so many companies we are looking to, which may be subject to the state aid consequences. But then the question is like whether the companies are going to appeal or not. And the companies are going to appeal because, to my understanding, these are not selective. And now the threshold observation is like, how the appellate court is going to decide on that one.
Got it. So, Surbhi, you've explained to us how the U.S. tax rules are likely to change. Maybe tax rates will go down, but we're not sure. Internationally, there are more and more attacks on U.S. business. As we look at how our clients go out and try to operate internationally, they need a treaty network. What's happening as far as the U.S. model treaty goes?
So I think in 2016, there was a new model convention which was introduced. So what that means, like any treaty ratification by U.S. or any new treaty which is being entered by U.S. with another country will follow 2016 U.S. model convention. And there are 5 main changes which appears to me. One is special tax regime. Under the special tax regime, the treaty benefits will be disallowed if the income is a passive income or there is no active trade or business by the source company or the source country corporation. The other one is like there are like quite a few changes on the limitation on benefits articles. So if you are dealing with any treaty ratification issue or any new treaty which was entered into 2016, I believe it was July 2016, but I might be confused with the dates. Sometime in any treaty which was entered post July 2016, then you might want to check whether LOB article provisions are being met. That is critical because you won't qualify for treaty benefits if you don't meet the LOB provisions.
Right, and limitation of benefits means I can't take an American company through another country to gain treaty benefits.
Mainly, exactly, yeah. So you need to have either it's going to be active business test, derivative test. There's a couple more, I'm blanking out on that, but those are the big ones. And ownership test, those are the 3 big ones on the LOB provision.
Got it.
Then there's also any treaty benefits for the payments to expatriated entities, which you all may be aware of, like 78, 74. Then those, if there are any expatriated entities, then the treaty benefits may not be applicable and may not be allowed. So those are the big areas. Yeah.
Wonderful. Surbhi, thanks so much. What we've gone through is a U.S. international tax structure that may change as a result of the election. We're holding tight. A European approach towards tax that is highly aggressive for U.S. multinationals.
That's right.
And is probably getting worse by the day, right?
Right.
And finally, what we see is in order to plan for our clients, we need to think through how we make sure we have good treaty protections as we build our structures.
Absolutely. Yeah, so those are the 3 big things. There are many big things which has happened, but I think since we are limited on time, I think that's what my observation would be to focus on.
And I believe that every time I've ever attended any conference on international tax, it always closes with, and consult your local tax advisor.
And
right?
consult your local tax advisor. So yeah, if you have any questions, do reach out to me. I would be happy to provide any advice.
Surbhi, thank you very much.
Thanks, Fred. Thank you. Thank you.